Welcome to today's Segal Rogerscasey presentation, Investment Outlook 2013, Macro Overview. Our presenter today will be Tim Barron, Senior Vice President and Chief Investment Officer.
On a global basis, there appears to be continued uncertainty despite the positive returns we've experienced from most risk assets over the last year or so. Now, this stems from a number of economic influences now punctuated by the saber rattling in Korea, continued conflict in the Middle East, and a significant power change in Venezuela. With interest rates being held artificially low by accommodative central banks and with inflation quite benign, growth remains stubbornly muted as globally consumers and businesses have been on a path of reducing debt through increased savings and through moderate spending. In the U.S., of course, there are some positive signs in a recovering housing market and with favorable developments in North American energy. With continued divisiveness in Washington regarding fiscal policy, it is difficult to be overly optimistic, however, for the U.S. Additionally, we now know that college student indebtedness has overtaken some traditional forms of lending as a substantial future issue for the Echo generation. We're now seeing that a number of institutions of higher education have their own financial struggles that may further exacerbate this problem. Healthcare costs continue to rise, an aging population appears ill-equipped to deal with their impending retirement, and finally, there's the long-term impact of the hidden fiscal drags of underfunded pension plans both in the corporate and in the governmental sectors. It's difficult to see in the rest of the developed world any beacons of positive news either. In Europe, they continue to face problems with Cyprus replacing Greece as the crisis du jour. The banking system is under pressure because of new funding requirements, and the gap between Northern and Southern Europe remains quite wide. Now, we do have new leadership in Japan, and that has many viewing opportunities there quite favorably. But if we think about the long term, can what was once the world's second largest economy truly recover given its demographic issues and given the mountain of debt incurred by the government? A cheaper yen that we've been experiencing may only be a short-term solution. Now, many look to the developing economies as the growth engine of the future, as they see domestic consumption and the growing middle class truly represent the possible fuel for that global growth. Yet those influences take many years to move the economic needle and may be negatively impacted by the slow growth we're experiencing globally in the economy today. In addition, there's continued volatility related to their uncertain political environments. China, now the world's second largest economy, has slowed substantially. That creates additional uncertainty regarding the potential sources of long-term sustainable global recovery. In sum, the mix of positive and negative news against that backdrop of continued accommodation by central banks causes us to be modestly and cautiously positive for risk assets in the intermediate term. Certainly, corrections are always possible when markets have performed well as they have over the near term. We do remain constructive, but we do have concern for the next phase as the world continues to work its way through the dramatic effects of the financial crisis and sails through what feels like uncharted waters.
Thank you for joining us. For more information on this topic, please contact our presenter, Tim Barron, at the phone number or email address shown on the screen.